Hello all, and welcome everybody to today's webinar, Asset Manager's Guide to ESG Investing, co-hosted by Paul Hastings and Vigilant. My name is Chuck Martin, and I'm the Chief Operating Officer of Vigilant, and will be the moderator for today's webinar. Today's webinar is scheduled for 1 hour and will feature 3 industry leaders, each with their own unique perspective on ESG, which will cover marketing, distribution, investing, product formation, and legal and compliance. Now I'm going to introduce the speakers. John Brett is the Managing Director of Distribution Solutions at Vigilant. He has over 35 years of experience within the financial services industry, uniquely holding leadership roles within asset management and wealth management firms. John began his career at Merrill Lynch as a financial advisor, then transitioned into running retail offices in Boston and New York, building a successful advisory practice. John has extensive experience in the distribution industry as head of U.S. distribution for BlackRock, with responsibilities for wholesalers, internals, and national accounts. He also was CEO for the MetLife broker-dealer, with over 10,000 advisors across 4 broker-dealers, leading the firm's efforts to provide a client-centric wealth management solution. We also have on as a speaker Bill Davis, who founded Stance Capital to bring a market investment portfolios that mitigate material, environmental, social, and governance risks, and to generate excess returns while at the same time allowing investors to align their portfolios with their belief systems. Prior to forming Stance, Bill was co-founder and managing director of Empirical Asset Management and portfolio manager on the EAM Sustainable Equity, a strategy he launched in 2014. He serves on the board of Ceres and chairs Ceres President's Council. Bill has taught environmental entrepreneurship at Columbia University Center for Environmental Research and Conservation, and guest lectured on sustainable investing at Harvard College, Harvard Business School, MIT, and Vanderbilt. We also have Vadim Avdeychik. Vadim is of counsel in the investment management practice of Paul Hastings and advises clients on various ESG matters, including launching new ESG investment products and setting up ESG compliance programs. Vadim has authored several articles on ESG and is often quoted in news publications on the topic. Prior to joining Paul Hastings, Vadim worked as in-house counsel with PIMCO, where he focused on aspects related to various registered investment products, including PIMCO's advised closed-end funds and ETFs. Now to go into what the format for today will be. The webinar will be split up into 4 segments and will be in panel discussion format. What you will not hear today is 4 people reading off PowerPoint slides. If you're looking for educational work papers or presentations, they are available to download in the top right-hand corner under handouts. Starting in the beginning of each of the first 3 segments, you will have 1 to 2 polling questions, which are located at the top right of the platform. There's an icon that is looks like a bar graph on the right-hand corner. And if you have so each of those questions will be answered towards the end of each segment. The speakers will give their perspective on the question and the audience's response. Lastly, in segment 4 will be entirely in Q&A format. You all will have the ability to submit questions throughout the webinar by clicking on the top right-hand corner. The icon is a thought bubble with a question mark in the middle. You have the ability to submit questions at any time. The speakers will do their best to answer all the questions you have. However, if the question does not get answered, the contact information for each one of the speakers is on the last slide of the deck, and you could follow up with them directly. Now, with all of the housekeeping done, we're going to go into the first segment, which is what is ESG. I'm going to ask Vadim to kick this off from a legal perspective, and Bill and John, please chime in with what the perspective is of the market.
Thanks, Chuck. Just want to say first and foremost that I'm happy to be a part of this and part of this panel. I think this is a very timely topic for the industry. And I feel like every day there's something new coming out from a regulatory standpoint. With respect to ESG, where we are right now is that there's very limited guidance from the SEC per se. And what that does is that really leaves it to the participants to determine what and how they want to pursue ESG investment strategies. And I think Bill will speak to that a little bit more in detail from an investment standpoint. But when I advise clients in regards to setting up an ESG product, what you really want to start out with is by looking at, what type of ESG investing are you going to do to make sure that you have the appropriate terminology in place, right? And what I mean by that is if you're looking to pursue an impact investment strategy, then you need to make sure that that's what you're calling it and that's how you are describing it in your marketing materials and so forth. And if it's an impact strategy, chances are it's probably not an ESG strategy per se. There are also others. There's impact, there's ESG, there's sustainable, there's responsible investing, there's thematic investing. And all of those have different investment characteristics, if you will. So right now, as I look from a regulatory landscape, what a lot of my clients are looking for guidance from are third-party metric providers. And there are different levels of providers. You have providers at an investment product level. You have providers that are at the advisor level. So for example, if you're an advisor and you're looking to set up to follow PRI 6 core principles, that's something that you will report on as an advisor. As an investment product, you're looking for a different standard. And again, there's nothing in the U.S. that is a mandated standard, but there have been some industry participants such as ICI and CFE that have floated some potential metrics to be used by investment managers when they're looking to launch an ESG investment product. And of course, there's also SEC that will have an input as you go through the registration process with them on an ETF or a mutual fund. Bill?
Yeah, actually, hi, everybody. And Vadim, actually, I want to pick up more or less where you left off. I do think ultimately standards are going to emerge in this space, but importantly right now, there really are none. ESG is whatever everybody agrees it is. And by that, I mean that it's up to portfolio managers, intermediaries, advisors, and ultimately the investor to decide on acceptable definitions of ESG for them. And this, it can be, ESG can be passive, it can be active, it can be large cap, it can be small cap, it can apply to individual sectors, styles of investing, even private company investing. It can be authentic, it can be inauthentic, and it literally is all of these things today. And in some ways, that's what makes it so interesting, because to me, ESG, it grew out of this thing called socially responsible investing, or SRI for short, but it's different from SRI in the sense that I think that there is an expectation, irrespective of how one organizes their product or their approach to ESG, there is an expectation of performance, which I think is both refreshing, and I think it ultimately will lead to many different kinds of ESG products over time. But right now we're sort of in the wild west of product creation and articulation and all of that.
Bill, I was struck by over my career that term ESG, the G being governance, and the fact that there has really been no governance in that space. With your experience, has there been kind of bellwethers that you've looked at to give you this kind of guidance for the governance decisions you make as a portfolio manager?
Yeah, that's a good point, John. I actually think that governance perhaps has been the most clearly defined component of the E, the S, and the G, in the sense that it's relatively easy to do things like look at independence of board directors, the degree to which the board chair is different than the CEO, board diversity, all of those things are, board compensation, climate training of board members. These things are actually pretty identifiable, and they're pretty easy for the aggregators to to capture and to organize and to resell. I think that the biggest sort of new thing going on in ESG is the discovery of the S, and the realization that a lot of the signals around S were really, I'm not going to say soft signals, but I think that they were a little bit more elusive. And I think that actually in 2020, I think between COVID and BLM, I think it has given a lot of ESG portfolio managers, certainly myself being one, some additional insight around additional factors that could be developed. A good example would be paid sick leave, which frankly, I never really thought about the importance of paid sick leave before COVID came along. But it makes you realize that in certain industrial or certain segments of the economy, it's actually critically important to performance, because if people don't have sick leave and they're not making a lot of money and they're working in close proximity with other people, the first thing they're going to do when they get sick is come back to work. So, and that's a risk to performance.
Sure. Vadim, a quick question, if I could, about the regulatory schemes or lack thereof. Do you expect the SEC to provide leadership with this, or will it be a FINRA, or if you remember a couple of years ago, was the Department of Labor and the fiduciary standard?
Yeah, that's a great question. And, I previously noted that the ESG regulatory pendulum swings with the administration that's in the White House. And unfortunately, I don't think it's an issue that should be politicized, because what it does is it makes people in the market unsure of how to react and how to plan with their compliance programs, with their legal setups, and more importantly, what type of products to launch, right? So we have, as you noted, SEC, DOL, FINRA. A good example, at the end of the year, or last year, we had DOL adopt two rules. One is a proxy rule. One is what type of investment should be considered when making an investment decision on behalf of ERISA plans. And while the final rule did not specifically single out ESG investments, many participants took that final rule to be sort of as making it very challenging for ESG to be a part of an ERISA plan fiduciary's toolkit, if you will. Well, fast forward to Biden administration, we have seen the DOL put an enforcement hold on those two rules that were adopted at the end of the year. And as last week, in fact, President Biden came out and said that he would like the DOL to review those rules and, in fact, consider how ESG can be better incorporated into these into ERISA plan strategies. So with that said, and then you layer on top of that the SEC statements that we have seen recently with Chairman Gensler coming on board, and Acting Chair Allison Heron-Lee putting out a request for comment that is about to expire in June 2015, I do believe that it's looking like we may have at least a proposal from the SEC with respect to corporate issuers and disclosures that they would need to make with respect to ESG risk factors.
Thanks for that.
So just as a reminder to everyone, a lot of people filled out completed the first poll, which roughly 85% of everyone agreed that in the upcoming 6 to 12 months, there's going to be more regulation coming out of the SEC. We're seeing same decrease pretty quickly. It looks like there's a consensus here that there's a belief that the SEC is going to come out with more regulation over the next 6 to 12. So with that being said, we're going to move along to segment 2. Let me just throw that up there. And we're going to start out, and we're lucky to have Bill on, who is a portfolio manager with 7+ years managing an SMA strategy with that is a SMA format that is an ESG strategy with a 5-star Morningstar rating. So let's kick it off with Bill.
Yeah, so I think, my sense is that there are folks joining us who are either interested in creating new products or are perhaps managing platforms where they're thinking about the kind of products that they want on the platform. So regardless of whether you're actually building product or thinking about incorporating product to have it be available to clients, I think it's important to kind of start at the beginning here. And I mentioned earlier that ESG is a lot of different things to a lot of different people. And I think that the first thing that needs to happen, regardless of how you're, where you are in this, in the evolution of this, is to really think about what it is that you're trying to accomplish, because there are many, many ways of building ESG product. And I would start by saying, who is the audience that you're going after and what do they care about? How are they going to define? Obviously, everybody's got a way to define financial performance, but how are they going to define non-financial performance? How are you going to source data? How are you going to ensure the accuracy of the data? Or if you can't ensure the accuracy of the data, because it's kind of difficult to do, it is a bit of a moving target, how do you at least think about incorporating data sources that are actually perhaps giving you insight into areas that you might not have thought out before? I mean, I shared the issue for us after Q1 of 2020. We said, okay, how do we make our portfolio more resilient? And we realized that paid sick leave was actually kind of like a big hole. And it led us to actually implement a data capture effort with our data partner, which is Corporate Knights based out of Toronto, around actually capturing data around what companies are actually doing with respect to paid sick leave, so we can incorporate it as a material risk factor. Speaking of material risk factors, I think that is a really big issue, because if you go on Bloomberg right now, I think you can find over 400 different ESG factors that they track. But there's enormous issues with fill rates between various companies. Not every company reports on the same thing. In fact, most companies don't. So if you want to compare two companies in a specific industry group, what do you do when half the companies are reporting on one thing and there's no standardization in terms of how they report? So it's very difficult to compare, various data elements. And so these are all of the things that I think, whether you're a portfolio manager or an advisor that is dealing with clients who are asking about ESG, or an advisor who I think has enough foresight to recognize that if the clients aren't asking today, they're going to be asking tomorrow, or maybe they're not going to be your clients. How do you get smart on these subjects and manage your way through the process? And then, of course, eventually you get to the point of what kind of vehicles do we need to satisfy the specific clients that we're looking for. And to me, the vehicle question is really the last question anybody needs to think about. I mean, ultimately, I think when firms get big, they take good products and they make it available in a lot of different wrappers. My firm, Stance Capital, is a small firm that grew out of a vision that I had not too long ago, but 7 or 8 years ago. And we, like a lot of small firms, simply started offering products to other investment advisors through separate accounts on conventional platforms like Schwab and Fidelity and TD and so forth. And then we started doing model delivery after that, because there were clients that were looking for a model delivery wrapper. And then one of the things that we recognized, and it's a very new experience. So for those of you who are interested in launching an ETF, or in particular a actively managed semi-transparent ETF, follow up with me afterwards, and I'll tell you about the process that we went through. But we made that decision because we recognized that ultimately our clients are primarily other financial services firms, and in many cases, they're actually looking to buy a ticker symbol. They don't necessarily want to buy individual accounts. And if they want a ticker symbol, okay, are we going to offer a mutual fund, or are we going to offer an ETF? And because we happen to be very active, and we think some of our performance edge comes from from being active, we decided that an ETF made the most sense simply from a tax perspective. But at the same time, we weren't anxious to publish our intellectual property on a daily basis. And so we made the decision to go with a semi-transparent form of an ETF, which then led to a whole nother set of decisions because there are many different providers of semi-transparency. And ultimately, we made the decision to partner with a group in the UK called Blue Tractor, who happened to offer a version of semi-transparency that that disguised the weights, but actually was fully transparent on the holdings. And our thesis was, if you're an ESG investor, you actually do care about what you own. And I get calls frequently from clients or prospects saying, tell me what's in your portfolio, and I'll show them the portfolio. And then they'll say, well, why do you own this? And I think, this is another important thing if you're in this space or getting into this space, is understanding why you do or don't own something is something that investors ask about and they care about. And I would say that as long as you have a well thought out answer, about 99% of the time that is good enough for the investors. What they want to know is that if there is a specific company in the portfolio, you've thought through why that company is there.
Bill, you and I got a chance to work together on that ETF offering and going through it, and was really impressed by your team and the idea of teamwork and running an ESG portfolio. Maybe you can describe a bit about that, because what I saw from your team was that you involved distribution from the very beginning, and so was able to get real insights of the way you manage the money and the decision process that you use to manage the risk, which I thought was a key differentiator for what Stance represents.
Yeah, so I guess I would say that an ESG portfolio, first of all, is just like any other portfolio, except that there's this additional thing that nobody understands how to describe, or in some cases actually market and distribute, because let's face it, many folks in the distribution industry have never had to think about it or understand it. And then, you add on top of that, I would say that to do ESG well, or to really do it authentically, maybe that's what I mean. To do it authentically is actually really, really hard. And one of the things that we try and do is be both dynamic in our approach to ESG, because let's face it, the world is not really all that static, right? Things change. So here's a good example. We, and this is, I guess, more based on my own personal values, because I was the first client of my company, but we disfavor fossil fuels, we disfavor weapons, we disfavor tobacco. And I would go on to say, we more than disfavor these things, we actually actively avoid them. However, what do you do about utilities? Because if you say to yourself, well, I'm not going to invest in fossil fuels, but here's a handful of utilities that basically transmit, transport, or distribute fossil fuels, should they too be excluded from the portfolio? And our initial thinking was, yeah, like, why would we invest in those? And then, but more recently, it becomes apparent that there's, more than a handful of utilities that have made date-certain commitments to be 100% renewable, and are actually spending more than 50% of their CapEx on renewables. Should those kinds of companies be excluded from consideration? And ultimately, we, I'd say, modified our positioning to create a set of rules that would allow for utilities to be included. Because look, the reality is we are not going to get to a lower carbon economy. And I recognize that that is only one component of ESG. I'm speaking to the environmental piece right now. We're not going to get there by simply investing in tech and healthcare companies. And I get that there's a lot of ESG product that is really kind of a proxy for big tech, and to a lesser extent, healthcare. But, what about industrials? What about materials companies? What about utilities? What about parts of the economy that are necessarily or are currently dirtier, but aren't going away? It's just that there are going to be winners and losers, right? And so what we try and do is be thoughtful and dynamic around all this stuff. And then the challenge is, how do you convey that passion and provide, I think, maybe anecdotes to distribution and marketing so that they actually understand these things and can articulate them to clients. And it certainly isn't an easy thing to do, but I would say every day we get up and try and do it a little bit better.
Yeah, I've been struck by that. And a couple elements I would share from, if you're thinking about this process, think of these numbers, which were striking to me. This comes from Morningstar. 2020, approximately 51 billion plus went into sustainable mutual funds and ETFs, or about 25% of all the money that went into funds during 2020. What I was struck by is the 19 flows. 2019, the flows were 21.4 billion. 2018, the flows were 5.4 billion. So if you look at that idea, it no longer is necessarily a trend, that idea of trend. It's a substantive way of investing. And Bill and his team have made substantive changes and think about it, I think, at that next generation of ESG investing. And I think that to me is a real significant difference of that first wave was, again, focused on certain pieces of it. Bill and his team have made that next step, which is that second generation of ESG investing.
And I know Bill talked a little bit about the different product wrappers that he's using for his ETF, but I assume there's a lot more wrappers out there in different products. So if you can talk about them, and if I'm someone interested in launching some ESG product, how would I go about doing that?
Yeah, and I mean, I think Bill laid out his investment thesis and his approach and what made the ETF wrapper appropriate for him. What I have started to see more and more as the market matures for ESG is that it starts to move into different asset classes, whether it's loans, bonds, fixed income, and the like. And I do believe that there are interesting opportunities out there to invest, if you will, in a less liquid asset class that is ESG related. So for example, if you think about a closed-end fund or a business development company, when I think about business development companies and the reasons they were started in the 1980s, it was a way for retail investors to access venture capital type strategies. And when I think about ESG and ESG type companies that will come about in the next 10 to 15 years, Bill, how many ESG unicorns are we going to see come about as a result of this tremendous demand to solve the climate crisis? So if you're a business development company whose purpose is to find these private companies, to invest in them and to be there for the long term, I think that there's a tremendous opportunity for the right managers to launch successful products. There's also the loan market, right? The private loan market is not as mature as, let's say, publicly offered equities. I think that market, as more standards come about that are enable managers to evaluate ESG from a loan on a particular loan and a company that they're offering to, specifically middle market loans or loans to smaller companies, I think there's a tremendous opportunity there. With all of that said, I think Bill laid it out perfectly to know that no matter what wrapper you ultimately end up with, I think it has to correlate to the investment strategy that you're running from the beginning and not try to shoehorn something just because you think that wrapper is going to sell. Because I think what that will make challenging for you is running that investment strategy in the long term. And when you go to market that strategy and when you go through the due diligence process with the investors, you will have to answer the tough questions, which is going to be, how do you measure it? How long have you been running it? How do you account for this? What standard setters do you use to make sure that you're not having any footfalls? So with all of that said, I think there's a lot of building that's done in the front. And when you're actually done, when you're done building, I think running the strategy becomes somewhat easier if it's natural to the investment process that you have established at the outset.
Yeah, and John, to piggyback off of kind of what Vadim had said about the wrappers, can you talk from a distribution perspective? Because at the end of the day, it's important to be able to have the ability to raise assets. So what type of factors should someone consider as it relates to ESG?
Yeah, thanks, Chuck. And I would highlight specifically is the idea of how these solutions end up on platforms. Because what has grown in importance is the research that these platforms now provide. And so my most recent role before joining Vigilant, I was the chief executive officer for Lockwood. And in that role, you could see what world-class research looks like as they make the decisions. So they go through a rigorous process to allow these solutions to be added to these platforms. And the platforms across distribution models continue to evolve. I, for instance, saw great growth in the bank channel. So there's an awful lot of great world-class professionals who are now parts of bank distribution models, as well as growth in the RIA space. Obviously, Schwab and Fidelity and Pershing being examples of great distribution models. All of them have very specific research that makes a difference. Finally, importantly, I think for this space is the growth of the TAMP platforms. And in those names, I would highlight Orion and Envestnet as being real world-class providers of those solutions that advisors are using. Key to that, and Bill used that term earlier, and to me it's vital. In my experience, it's being authentic. Because one of the things about these research and the pieces that we provided at Lockwood was that we could see what was authentic. And in Bill's case, clearly believes in this space, has made a personal commitment to it and understands it, and does his team. And that substantially made a difference for us, and I think the performance shows that. So going up front is making that, as Vadim described, early and up front, being authentic about this commitment in the ESG space, understanding the vital part of being on these platforms, and then finally looking at what distribution will look like, the changing nature of distribution. I, for instance, would look at this idea of what is the next generation of financial advisors? Where will they get content? And does your firm have a digital solution, an offering that can get the content that Bill and his team represents out directly to those advisors who make these decisions? So to me, it's a combination of this technology and obviously in Bill's case, being authentic that will make a difference for stance going forward.
Do you have anything else to add before we have three polling questions, which we have answers to, which we can run through and get your thoughts on? Is that okay to run with that?
Yeah, let me just actually echo something that Vadim said, which is that I firmly believe in this idea that we are kind of very much at the early stages of this. And as this evolves, you're going to see a lot of new types of products created. Not only focused on public equities and debt, but even sort of public, or I would say combinations of liquidity and illiquid components. So think of sort of like an interval fund structure that has, public equities that act as a liquidity lever, but at the same time has, for example, illiquid climate solution strategies for people who care about that, or perhaps CDFI loan portfolios for people who are focused on community investing. So I think we're going to see a lot more of that. And it's going to be certainly interesting from a legal and a regulatory standpoint as these products come to market.
Yeah, and I would just piggyback to that. I think that's a great point. I think there's a lot of strategies out there, and especially strategies that you want to ensure that you have a longer horizon in terms of success, right? And I think such things as interval funds, closed and tender offer funds, they offer that, especially to retail investors, an ability to access a bigger, just something more than your S&P 500 ESG strategy.
Mm-hmm.
Right. So into the polling questions. We see about a 95% of our attendees plan to increase their ESG exposure for their clients, which is something that I don't think anyone is surprised with the trend. But moving into this segment, I would like to hear what your thoughts are. Is which of these do you find most important to ESG investors? About 90% view values alignment over better returns is 10%. Lower risk is at 0% of the attendees on this question. So to get the panel's thoughts on that, Bill, let's start with Bill on that.
Well, I think I don't think of them as mutually exclusive, actually. I mean, so I tend to go back to, like, John, you were talking about the the flow of assets into this space. And I think you quoted like 5 billion in 2018 or something, and then it went to 20, and then it went to 50, and it just keeps going up and up and up. And pre-2019, or actually, let me back up. Pre-2015 or 16, every product in the market was what I would describe as more of an SRI type product. And I would say that the asset flows were fairly unimpressive at that point. In other words, we sort of found the 20 or 25 billion of assets, and it was pretty steady amount of people who basically had made the decision that they were more interested in values alignment than returns. And I know that maybe is being a little bit unfair, because I'm sure that there were SRI managers who performed quite nicely. But, the fact of the matter is that the collective track record, I think, was not all that compelling. And therefore, I think that it really, I think there's two things that have happened, or three things actually. One is that there is increased investor interest in values alignment, which is a function of a lot of things going on in the world today. And we don't have enough time to really kind of unpack that statement. But I think that's a bit of it. I think secondly, enough early managers in the ESG space have proven, at least thus far, that values alignment can be a free option if portfolios are constructed properly. And that, I think, just creates more interest among investors for doing this. Like if I can avoid things I don't want and concentrate on things I like, and I don't suffer for it financially, like why wouldn't I want to do it? I think it's kind of almost that simple. And then I think the third thing is, though, that I think the financial advisory community, which frankly I think was the sand in the machine for probably 4 or 5 or 6 years, I think has woken up and recognized that, oh, actually our clients do want this. And oh, by the way, we're in the middle of a generational wealth transfer where a lot of money is going to move into the hands of younger people, more female audiences who are more interested in this kind of investing. We better catch up and we better get smart about it. So I think all of those things are happening, but I think central to the permission for further advances in ESG is to continue to perform well, because that's what's going to make this a bigger tent for everybody, I think.
Bill, I would describe as well from the advisor point of view, what has happened is obviously the continued growth of the unified managed account in the traditional broker-dealer community, as well as the growth of the RIAs who've embraced this term fiduciary. And so they've clearly made those decisions. So if you look at that timeline over the past 5 to 6 years, you've seen a tremendous growth in those solutions. Particularly to your point, they now have very specific solution that fits the ESG need that these investors have. And the match is really what has taken place. The solution matched it. Finally, I would share from a distribution point of view, it's been a remarkable equity run. And I've been struck over my career. Sometimes we'd sit in these meetings and it's almost like we forget what has gone on in the equity market. It's been a vital contributor to the success of ESG, because the equity market and the performance that has grown, because retail advisors, the core best ones I've been around, have focused on that alpha. The portfolio managers and skill sets that Bill and the team represent have been able to provide that. And that's really where that match has taken place. And to Chuck, to your point about it, that's the magic that has taken place with this ESG hitting at the right time. And to Bill's the opportunity going forward, you can just see the generational changes about the investors and what they're going to be looking for with the advisors, the distribution model that they're utilizing, but also the PMs and their ability to bring this market, that message to this market.
That's interesting. It's an interesting point that you bring up, John. And I think it has to do with, a lot of times I speak to clients, and when investors come to them, they say, you don't have the track record, right? Because ESGs, as Bill pointed out earlier, maybe it doesn't have the 10, 15-year track record. And I think as we start to see that, we also have run into a market that has performed incredibly well in the public equity side. And as Bill noted before, some of the ESG funds hold things like Facebook and Amazon and what have you. So it'll be interesting to see when the market turns the other way, right? From a regulatory disclosure standpoint, I think about what type of disclosures you need to ensure that you have in your offering materials and your marketing materials, that when and if the market turns sideways on you, that you're prepared and that you're sort of ahead of that curve. Because we have seen enforcement actions, right, by managers saying they will do a certain thing, but it ends up they did not have those things in place and their disclosure was wrong. And that's something that you should be thinking as you go through these periods of where you're sort of lulled into complacency, if you will, because of how our equity markets have performed.
Yeah. So Vadim, we're now into your segment on ESG governance. And so I think you had a great intro into governance. So do you want to hit a little bit more onto that?
Yeah, look, thanks, Chuck. I mean, I think we're in an interesting time from a regulatory perspective, and I can only speak to, at least for purposes of this webinar, to what's going on in the SEC. There's a whole other things that are happening over in Europe, which are interesting and maybe for a different audience. But from an SEC standpoint, as I noted earlier, there is a shift that's happening as a result of the administration change. We have seen a lot of new. I don't know how to put it, and maybe guidance is the right word for it, but we can start with the fact that Division of Examinations at the SEC, which is responsible for going on the ground, examining registered investment advisors, asset management firms, and the like, has put out an ESG Risk Alert. And anyone who is in this space, I urge you, I will not go through the many pages of the risk alert, but I urge you to pay attention to that risk alert, especially the investment professionals, the marketing folks, and the compliance. I mean, I think there's a lot there to take away in terms of setting up a robust compliance program, and especially what the enforcement examinations thinks you should be doing. Which stakeholders are you involving when you're in the process of launching a new ESG product? And once that product is launched, how are those stakeholders continue to stay involved? The risk alert talks about having knowledgeable compliance personnel on the ESG strategies. That's something that's interesting because I don't know what knowledgeable means, but I think you can kind of get an idea that you can't just bury your hand in the sand and just hope that the ESG strategy will work out well. So what I take away from those things is that you need to be intimately involved, and you need to be involved from the beginning process so you understand how the investment professionals will run the portfolio, what kind of metrics they will rely on, and that you can ensure that you build appropriate policies and procedures that you can capture any potential deviations from that, right? Because you will also have investors come and ask you questions and say things like, hey, I see that you included some gun makers in your portfolio. How did that end up in your portfolio? And your response can be, well, we follow XYZ index provider. We don't know what they're doing. They provide us the metrics. We replicate the strategy, right? So maybe that's a fair answer, but from a PR standpoint, how will that look, right? And I think it's important to kind of think about those things as you're building out your portfolio. The other side of it is, outside of the examinations risk alert, there's also the SEC noted that they have established an enforcement task force, an ESG enforcement task force. And it'll do a couple of things. One of them will be looking at advisors' disclosure obligations and fiduciary duties as it applies to advertising materials, marketing materials, and obviously investment products. Now, it's interesting when I think about an enforcement task force, as someone who spent earlier part of his career working for a regulator, if there's an enforcement task force, an ESG enforcement task force that's been established, I do believe that there's going to be some enforcement to be had. I don't think they would spend the time and devote resources to this area unless they have seen something that they don't agree with, don't like, want to change. And I think you couple those two things, the risk alert, the enforcement task force, the change in the administration, and if I'm an industry participant, I am taking this as being put on notice that the SEC is looking at us with a strong lens. And I think what you can do from that is you can look at the past SEC enforcement actions, not in the ESG space, but in other spaces that could be illustrative for purposes of establishing a good ESG policies and procedures internally, right? So, and I also worry from a standpoint of enforcement is that there isn't, as we discussed previously, there aren't specific standards, ESG metrics that the SEC has mandated. And what I worry about is if they have this task force, will this somehow lead to rulemaking by enforcement? We previously saw something happen on the share class initiative, where the SEC went after against registered investment advisors and others, broker-dealers, for failing to dual registrants, for failing to put shareholders in the lower share class available to them, right? And I think there, a lot of industry participants were sort of kind of, they were surprised by it because there wasn't specific rulemaking that obligated them to follow or to do certain things, but yet the SEC went after the industry in a strong way, and I think something similar can happen here, and I really do not want that to resolve, because I think if there is an ESG rulemaking that the SEC wants to do, then I think they should go through the proper process, which is a proposal and adopting rule. And rulemaking by enforcement is something that I worry about. And based on what we're seeing so far, it could be going that way, but obviously only time will tell. So just kind of by wrapping up in terms of what folks in this area should be thinking about is looking at the risk alert, thinking about what they can do to set up a robust policies and procedures, internal process, working with the stakeholders, looking at past enforcement actions that could be a guidance in terms of what to look out for when you're thinking about these things, right? If you have a sub-advisory relationship and you're relying on a sub-advisor to provide you the data, make sure that you're actually vetting the data. Don't just take the data at its face value and incorporate it without any due diligence. If you're building out proprietary mechanisms, whether it's focusing on qualitative data, make sure that you're testing that data, regularly to ensure that there's no gaps. We've seen enforcement actions happen there as well. So all of these things make it obviously a very challenging environment, but at the same time, I think if you prepare yourself well, then when the SEC comes on knocking, you will be ready and you'll have a good answer as to why and when you did what you did.
Vadim, a quick question, if I could, in reference to Paul Hastings and the content available there. Are there other suggested sites that you would suggest portfolio managers, RIAs, the audience for our webinar today, to go to be kept up with these kind of changing regulatory schemes as they were being rolled out?
Yeah, absolutely. Great question. I think there are various trade groups that I'm sure RIAs are part of that push out certain content that is informative. Some of the things that I like to focus on, I obviously, SEC.gov, that's a great resource always. FINRA, could be a good resource. There's also ICI that pushes out great content in terms of mutual funds and other registered investment type of products. Unfortunately or fortunately, right now there's so much coming out from different parts at you. When I prepared for this webinar, it's just almost impossible to keep track of everything. And I think that it pays to partner with strong, knowledgeable, whether it's distributors or folks that are internal employees that help you keep abreast of those situations so you can focus on running your portfolio or marketing the fund.
It's funny you mentioned a lot of information. In preparation for this call, I Googled ESG investing. There's 43 million hits. And so to your point, it's almost daily. There's multiple big stories written about it, but obviously keeping updated in the regulatory schemes and vitally, you think of our industry 5-6 years ago and the changes that have taken place if we had had this meeting 5-6 years ago, this idea of fiduciary standard would have been top of mind for all of us. And yet here we are dealing with COVID, dealing with the ESG world, and I think impactfully making these kind of changes. To your point about using professionals, your firm and obviously other professionals are out there to help these RIAs and portfolio managers make these important decisions.
That's a great point. And what I worry about, and this is something that I kind of alluded to earlier, is the regulators sort of playing gotcha, because there is so little guidance, but yet there's so much information. For example, that risk alert or the enforcement task force. So as a professional in this industry, you're accepted to, take all that information, be able to digest it, and then be able to actually implement it to the extent it's applicable for you. But you can see how anybody, a regulator could be a Monday morning quarterback and to come along after the fact and say, look, we told you about this. And similarly, with your point about COVID, right? We've seen how many, for example, SEC brought an enforcement action against Cheesecake Factory for not properly disclosing their revenue numbers because they should have known that as a result of COVID, everybody was going to stop going to their restaurants. So, things like that, you almost cannot anticipate everything that's coming your way. It's just an ever-evolving, changing world. But I think if you can show a process, you can show a thoughtfulness about it, I think that'll take you a long way.
Great. So that would conclude segment 3. On to segment 4. I encourage everyone, you can still ask questions through the icon with the question mark in the thought bubble. We do have some questions already in, so I'm going to read them off, and the panel, please chime in. So the first one is, ESG reports in other countries such as Singapore are prepared in accordance with GRI. Is there one that is common in the U.S. that advisors should consider as a standard framework? Bill, if you want to jump into that.
Yeah, I'm willing to tackle that. The answer is no. And I would say that right now we're in this kind of confusing state where, for the most part, portfolio managers report on their own impact. And in some cases, it has to do with engagement. In some cases, it has to do with decarbonization or gender equity or something else. And in many cases, it's unaudited, unverified. And, to Vadim's point, there may be a day of reckoning at some point around some of this. Regulators, for the most part, have focused on financial claims, but it'll be very interesting when they start, if they ever do, start looking at impact related claims, because I think it's a whole new world. I would say that, there are two major data aggregators or data processing firms in the ESG space. One is Sustainalytics, the other is MSCI. They each have a framework for assigning sustainability to products that are out in the marketplace. And I'll tell you very quickly, like for Stance Capital, we get very different scores from each of them. And the reason, and then there's a third, which I think is gaining some traction. It's called Impact Cubed. But one of the reasons why they have very different outcomes is because they actually look at different data elements. And so I think it's, it adds to sort of the confusion in the landscape right now that there isn't sort of one standard. Vadim mentioned earlier that in Europe, they're working on an article-based, almost like a rating system. So think of it as like a bond rating with different levels based on the veracity of the ESG approach as much as anything. And while that is hitting a few roadblocks, I think eventually we'll get there here as well. Something will emerge.
Great. So we have another one in. Vadim, I think this one's for you. Can you recommend an example of compliance policies and procedures that might satisfy the SEC? I'm assuming this could be the quality of data, the review of sub-advisors. What would you envision being in compliance policies, procedures that, if you're an advisor investing in ESG, that you should have in place?
Yeah, I urge anyone who's thinking about building out of policies and procedures to look at that ESG Risk Alert. I think it is very informative in terms of what they're looking for and what they did not like when they saw it on the ground. I mean, ultimately, it is important to note that there's nothing in the Advisors Act, the Investment Company Act, that deals specifically from an ESG standpoint, right? So with that said, and what Bill mentioned earlier, when you're talking about the different metrics, when you're talking about the different standard setters, when you're dealing with clients, it is important to ensure that you have policies and procedures to capture any inconsistencies that may happen, right? If you're running one portfolio side by side with an ESG portfolio, and you have to vote proxies for one and versus the other, how do you ensure that the portfolio that's not ESG should or should not be voting the same way that the ESG portfolio is voting? If you have an investment in a different part of a structure, whether it's equity and debt and vice versa, how does that impact the different portfolios? I think ultimately what needs to be done, there has to be a thoughtful process about building that out. I worry about taking anything off the shelf and saying this will satisfy a regulator when they come in. I think when a regulator comes in, they want to ensure that it's nothing that's just a kind of a template policy or procedure, but a procedure that has been thought about and actually fits the strategy that you are running.
Great. We have another one in. So if you are creating an internal ESG board or social impact board, where can you find examples of these boards and what their responsibilities are as a whole? How involved would the board be from daily workings of the portfolio, or are they more for oversight purposes? Any thoughts?
Yeah, I would say that an ESG board inside of a financial services company should be involved in oversight, not in the daily workings of portfolio management. And that's maybe self-serving because I'm a portfolio manager, but I do think that portfolio people need to do what they do. And I do think I actually think it's a good idea because, like one of the things that bothers me a little bit about ESG is the fact that there's a lot of financial services firms jumping into it because it's sort of the hot dot right now, right? And so, and I get that that's how kind of the world works, but one of the challenges therein is that their interest in this is one-dimensional. Their interest is in actually just growing assets or having other products to sell or not being the one firm that doesn't have an ESG product. And so I think that by having an internal oversight board that is thinking about ESG holistically on behalf of the firm, like what's the firm doing around diversity and inclusion? What's the firm doing around hiring practices? What's the firm doing in terms of community support and philanthropy? Those are all important things for every firm to be thinking about, not just a company that you might evaluate as to whether you want it in the portfolio. And so I think it's an important role for financial services firms to be thinking about ESG kind of multidimensionally.
Okay. And if this is, say, I guess, ESG 2.0, what do you all envision ESG 3.0 being?
I would describe it in my view this way, that if you look at what my children have never purchased a newspaper and held it in their hand, and they've had information on their phones and around them in a digital world, what will that look like for ESG going forward, the impact? So Bill, in decisions, you look at the kind of board involvement. So if you look at boards and their makeup and that kind of impact, or the Black Lives Matter in the impact in our society, those type of decisions you can see just growing. The numbers I was struck by before COVID, there was a number that came out I was struck by just today. 38% of Gen X had ESG in their portfolios. 18% of baby boomers. Okay, boomers, we missed it. Now, it turns out Gen X is at 58%. Baby boomers are now at 38% of their portfolios. So to Bill's point, we've seen substantive changes about that next generation. And to me, this is not a fad. It is just a core way investors will get alpha for their portfolios because, in my view, it's the outcome that matters. And that's the real element. I think ESG blends that together.
And I have one last question before we end the webinar. What steps should be taken when launching a new ESG investment product? I know we touched on it, but at a high level, what steps should be taken? Vadim, if you want to kick that off.
Yeah, and I mean, I think Bill sort of summarized it very well. And I also noted earlier on, I think it's important to set out the key stakeholders. Obviously, the investment thesis at the outset will drive a lot of the things, including what type of product is best for you, getting involved the key stakeholders, establishing a process, building out the policies and procedures, and engaging the appropriate service providers from a distribution side. If you do not have internal distribution capabilities, engaging that appropriate marketing firm. The distribution platform will play a big role in that as well. So then keeping an eye on what's going on from an ESG regulatory standpoint to ensure that you're well prepared to head off any potential compliance pitfalls.
All right. So, as we come to conclusion for our webinar today, I want to thank everyone in attendance, as well as our speakers for their insight on ESG. There's a couple of items I want to highlight before we end. As we discussed in this webinar, Stance Capital's ESG strategy is available both through the SMA and ETF format, which is listed on the New York Stock Exchange under the ticker STNC. Check out Stance Funds to learn more. We've also included, sorry, I did not have the upload of the presentation. Additionally, included in the handout section, you'll see a 2-pager on sustainable investing from Paul Hastings. This is going to include areas which they can assist RIAs. I encourage everyone to check that out. There's a lot of good information on that. Additionally, for those that are in need of CLE credit, we have the code on the screen, but we will be sending that to all of you separately via email. And then lastly, we have the contact information for each of the speakers. Should you have any outstanding questions from the webinar or need anything further, you can contact them directly. But we will also be sending you all the handouts that are available for upload on the platform. So we thank you all again and have a great Memorial Day weekend.
Thank you.
Thanks, everybody.
Bye.